This is Behind Closed Deals.
We'll be chatting with multifamily maestros
Uncovering their strategies
and unraveling the latest market happenings.
bringing you intel you can't buy. Hi, this is Hannah Ott with CBRE in Indianapolis, and welcome to our podcast, Behind Closed Deals. We're excited to talk to you today about our perspective on Q3 2025. Joining me on this podcast today is George Chickajohn. George, we say hello.
Hello, everybody.
He's more excited about Q3 than his voice would indicate. And Cameron Benz.
Hi, everyone.
See, that's real excitement right there. And so that's right. We're salespeople after all. And Claire Hausfurther.
Hello. Hi, everyone.
Hi. You have one portion of the brokerage team on the podcast today. So we've got 4 of us that are based here in Indy. Our other Indy-based broker, Sean Pingle, is I think out golfing with a client, and then our friends in Columbus, I'm sure they're out working very hard on this Friday afternoon as we record this podcast. So we thought we would share a little bit about our perspective on what Q3 looked like for deals that we were selling and just sort of market perspective. So I'll give you a little overview. In this quarter, our team closed 9 transactions. The average deal size was just under 300 units. Average price was just under $33 million. We just looked at this data, so it's very fresh. The average cap rate of the deals that we closed was 5.5%. And a couple of things that are noteworthy with regard to transactions are we did close a deal that was over $135 million. And we think that's going to be the only $100+ million multifamily transaction this year, which kind of speaks to what's going on in the market. George, what do you think that means, that there's like one deal that's over $100 million that's going to sell this year?
I think it just means that a lot of property owners are waiting for a more opportune time to sell.
Well, it's just hard to raise equity today, right? I mean, on all the other deals, in 2021, selling a $100 million deal to a syndicator was not as big of a problem. Today, selling a $20 million property to a retail syndicator could be a big problem. It just depends on who they're raising the money from.
Right.
Well, and if you look at those sales too, most of the owners, sellers had a specific reason for selling. So that kind of speaks to what George was saying. Sentiment in the market is that rates are going to drop. It might be a more opportune time to sell Q1 of next year.
That's right. One of the things that surprised us actually as we looked at these transactions in preparation for this podcast is out of 9 transactions, 5 were actually either off market or we were about to hit the market, and they were sort of direct deals. That's unusual for us. We typically fully market majority of our listings, and a couple things were at play here. Some of it was seller preference. What else do you think, Cameron, is driving this sort of like, okay, if we could make a deal at our price, we'll do it?
To me, the most interesting thing is in the frothy market, 21, 22, buying off market typically meant that you didn't go through the best and final and the best and final, the 4th round where you get countered and all that, and you get pushed up. Then you're just paying a little bit over guidance, and that felt like a huge win. Buying off market today, pricing isn't so efficient. Maybe you're getting a good deal, maybe you're not. To me, if I was the buyer, I'd want to go through a full marketing to make sure there are other people with me standing there, right? And it's kind of the opposite feeling, but we're happy to doing more of those deals because sellers either have more of a time constraint or they're just like, if I have a buyer in hand at the price that makes me happy, let's just go ahead, as long as they're a quality group.
Claire, you said this. You said a lot of sellers today have some sort of motivation to sell, and that's why they're not waiting for maybe pricing that's a little bit more peak. What are some of the unique motivations that we're seeing of these sellers? And a number of those folks did direct deals or off market with us.
I mean, one that comes to mind is an exchange that they're buying a property. So that's a unique motivation that they're gonna sell a property to then exchange to one that they've maybe already even closed. But it could be a partnership reason, it could be a debt reason. There's a handful of reasons, but we are seeing that, they're not just selling because they think they can hit top of market prices. There's some sort of motivation behind it.
Yeah.
Yeah, I think none of the sales were people who were selling for the highest possible profit. They all had targets, and if you could hit the target, they wanted to expedite the process and get it done as soon as possible, not stretch and get the last dollar of price.
George, you said expedite, and I think that's such a good way to when you look at these sales that we did off market. Why did we do them? We got to a price that was acceptable to the seller, but also we were able to close in some of these. One of the deals that we sold that was distressed. George, how quickly did we close from the time we brought the opportunity to the lender? Like 15 days.
Well, it was a property that was in default and was about to go in receivership. The receiver didn't the lender didn't really want to put it in receivership. The owner did not really want it to go into receivership. So the owner had a specific price that if he could get it at that price, it would pay off the debt. The lender even took a little bit of a discount on some of the penalties that had accrued. The buyer was motivated because they were buying it without competition. It was distressed from a debt standpoint, not so much from an operational standpoint. It was just a little over levered when it was financed, and the owner wasn't able to achieve their projection. So that's why they couldn't refinance it, had to sell it.
Looking at cap rates,
We've got a couple of others that they haven't closed yet, but a couple of others just like that, where we've got properties that are on the verge of going into receivership, and the goal isn't necessarily to get the highest price, it's to solve a problem, both from the lender standpoint and the owner standpoint.
looking at quarterly activity, our third quarter is actually going to be our quarter where we had the least amount of closings. And the fourth quarter probably is going to be the largest, with somewhere between 14 to 17 deals, depending on where things actually hit. So it was a little bit quieter this summer. Looking at the cap rate on these deals, if we take out that one distressed deal, which was a sub 4 cap, but it was only 70% occupied, the average in place cap rate was 5.5%, which makes sense because his average deal age was 1996. So really all of these deals, with the exception of one that was a newer construction deal, but a small property, they had some element of value add. And 5.5% today is maybe positive leverage, maybe neutral when you're just looking at the interest rate without amortization. And so that's still getting deals done today. There's only one sub 5 cap in the mix if we take that distressed deal out. And that was a deal that had some pretty significant value add potential.
Value add. The other interesting thing, I just thought of this, we hadn't talked about this before the podcast here, is
I can't wait to use this new information.
most of the year, let's say most of the first half of the year, with very few exceptions, our team had most of the properties for sale. There weren't that many properties on the market. Now, in the last 60 days, there's a bunch of properties on the market. And I think everybody can give their own take on why that is. I think one thing is folks have been waiting for the market, for interest rates to go down and for the market to get better. And when long rates did not really go down, it's like, okay, well, we got to pull the trigger. Let's sell it. There's no point in waiting. And we've had a lot of owners approach us in the last 60 to 90 days. We've done a lot of BOVs for people who are really ready to sell now. I think this concept, interest rates will be lower 3-6 months. The market will be much better 3 to 6 months from now. is, I think the market is feeling that less now than they were several months ago.
Yeah. Cam, what do you think about properties on the market today? And there's been a boost of deals coming to market this fourth quarter. What's your perception of that?
I think that there's still the market is learning more about how properties should be priced. The brokers, it has to go get spread around for them to all properly price properties as well. So I think we have a good understanding. We've worked on a bunch of deals, and now we're starting to see these other brokers who are still using metrics or, return on equity or expenses from a year ago to value properties today. It's just not applicable. And so we have to let them go learn their lessons, and then we'll all start to be at the same page, right? That's kind of where we're at.
So, speaking of learning our lessons, and we don't just talk about the upside, how many properties we have on the market in 2025 that we did not sell, that we pulled from the market? Not properties that we're still working on, properties that we just pulled off the market because the pricing was too high and we couldn't achieve.
So we just provided this to a client actually, and it's 4, which represents about 10% of our pipeline, with an asterisk of maybe a 5th one. And the reason the 5th one has an asterisk is we're still kind of working on it. There were so about 90% of what we'll bring to market this year will trade, but we try to be very disciplined about not over promising or overpricing. And so there were listings that we may have been had the opportunity to get selected for, but we were not at pricing that that expectations. Doesn't mean we would have been hired if we would have gotten their pricing, but that automatically took us out. So there are 4 or 5 deals that we're not still actively working on. And Cameron and I actually just looked through this list recently together. And our takeaway was it just was market price. It was the market was willing to buy all 4 of those properties, but it didn't make sense. It would not have been best outcome for the client to sell at that price.
So of those 4 properties, were they A, B, or C deals? Were they older vintage or newer vintage? Why don't we say that? And was it cap rate and pricing driven, or was there some other reason for those properties not to sell?
Yeah, might because I remember they were all workforce housing deals, right? Older.
They were all, they were all workforce housing deals, I think, other than one. And the workforce housing deals had a mixture of probably buyers underwrote a little bit higher capex than the broker or used higher expenses. We were generally in line with what a buyer thought they could be on upgrade rads, in place rads, what market vacancy is, what bad debt is, all of that. It's just, what does it take to hire someone to be on site, and how many people do you want to have on site? Is your business plan going to be based off of doing all this work in house, or is it going to be contracting out all the maintenance work along the way? And then how much do you have to actually pay to replace all the roofs? And, do you want to do siding work? And that's where we were off compared to them.
Yeah.
The
No, that's
non-workforce housing property, was it just too low of a cap rate? You couldn't get buyers at that pricing, or were there other issues? I can't remember which property that is. So
Yields were too low. Yields were too low.
yields were too low.
yeah, yields were too low. So how are buyers underwriting differently today than they were 6 months ago?
I at the Chicago event that we had with CBRE, where there was a Midwest panel, and they had 3 buyers get up. It was a institutional buyer, a buyer of older vintage assets, and then actually a tertiary market developer. And what I thought was so interesting is the guy that buys 60s and 70s properties, someone said, "Hey, how do you get comfortable buying a 70s property today for mid 100s a door? Because that's where it prices, that's where the yields price." He's like, I don't really care. All what you care about is where you're going to exit. And he's like, I ultimately think in 7 years, I just want to make sure that my exit isn't, 300 a door, and all the 70s properties have traded, the height of the market for 200 a door. That doesn't work. He's like, I just make sure that my exit price has been reached at some point in history right? He's like,
Yeah.
you will get back there. He's like, I'm not setting the high watermark with any of these. That's like it comes. I was like, that is a great way to think about it, I think.
Yeah, that is interesting, and I feel like that is when we do get pushback on those older deals, it's like, what price am I gonna sell it at? So that's great to keep in mind. And we have had success. I mean, we had a '70s deal that we recently hit exact pricing guidance on, so there still are buyers for that type of product.
And there's really buyers for all kind of product that I was interested as I looked at our pipeline of what has closed this year. So we think we'll close about 45 deals this year. And man, it's a third, a third, and a third. Almost exactly. It's crazy. It's about 15 class A deals that are 2000s and newer. It's about 15 80s, 90s deals, and it's about 15 workforce or deals that have some affordability to it. So there are buyers for every asset class, but they are being disciplined in what they are and how they are underwriting.
Right. Right. And people care about location a lot more today as well. I think that people are more, yep. Seems obvious. Real estate, the most important thing is location. I think today, more than a year ago and more than 2 years ago, people are wanting to know how are the schools rated or who is actually living here, who will live here if I raise the rents, how affordable is this compared to all the other comps? It all matters again.
That's right.
It interesting thing is if somebody asks us, what sort of cap rate will a newer vintage property trade for? We're generally saying 5.25, 5.5. Obviously, there's exceptions to that, but that's just very general. But if you look at the bid sheet, the offer summary, if we get 15 offers on a property, we'll get maybe 3 that are in the low fives, occasionally below 5, depending upon the deal, but let's just call it low fives. But the majority of the other 75% of the offers will be between mid fives and low sixes. So it's a very inefficient pricing market today. In other words, there's a very wide spread between offers that we're getting from buyers. And we're talking legitimate buyers making legitimate offers.
George, do you remember 2 years ago at Industry Outlook, we did a slide and it was trends that we had found, and it was the spread between the top offer and the bottom offer, and it had about doubled on a percentage
Mhm.
basis. And I think that that has not changed. Maybe, we call the bid ask spread. Um, you know, that has maybe gone down a little bit from a year ago to today, but it's not that different.
Yeah. And buyers are less shy to make an offer that's not at guidance because they're feeling like there's still price discovery in the market. So it used to be a couple years ago that if you were not at guidance or very close, it's just a total waste of time to spend time on the property. Buyers now know that there may be more of a spread and that their sellers are still experiencing some price discovery. And so it's worth your time to spend time on deals, even if you're not at guidance.
Well, there's a lot of buyers that will tell us, I was, when I made an offer, I was third or fourth, and they came back to me because buyers number 1, 2, and 3 all faded away for one reason or another. So that's another reason to put in an offer, even if you're not a guy.
Yeah.
I talked to a buyer yesterday who said, depending on the area of the country they look in or the broker, they just subtract 10% off the guidance immediately. And that's what they underwrite to.
Well, they're not offering on any of our deals.
No, they know. That's why they're telling us.
That's all.
So a little secret to people who watch this podcast. For the most part, when we have an owner that will listen to our recommendations, our guidance is generally where we think it will trade. We have competitors that for sure will have a much higher asking price than trading price. But the reason that we recommend pricing properties that the guidance be close to where we think it'll actually trade is that we have more buyers, more competition, and better price discovery. If you have a, a much bigger gap between asking price and where the market really thinks it is. You're going to lose a lot of buyers, and the price discovery, it's not as efficient, and you lose a lot of buyers. I think it's a disservice to go out way overpriced.
You heard it here first, guys, from the godfather of apartments in Indiana. Well, thank you guys for tuning in to hear our perspective on what's happening in quarter 3. We hope that in quarter 4 we get on here and we're like, we sold a bunch of deals at 4.25 cap, and the 10-year treasury is at 3.5%. But regardless of what we find, we will be back here again for another quarterly update, and we're going to have some podcasts in between. But we're going to tell you like it is, and we will tell you what we discovered, and appreciate you guys jumping on. And just remember what George says, you're only as good as your next deal.
Great. See you guys.
Thanks. Bye.
Thanks for tuning in. Stay in the loop by hitting that subscribe button, and check the show notes for additional resources.